I want to tell you about a pattern I've watched repeat itself with remarkable consistency across different assets, different decades, and different institutional actors that I think is one of the most important and least understood dynamics in the history of modern finance. The pattern goes like this. An asset emerges outside the established financial system. It is, by design or by circumstance, difficult for large institutional actors to access, to price efficiently, or to position around. For a period of time, sometimes years, sometimes longer, it trades primarily among participants who are genuinely committed to what it represents. Its price is determined by a relatively direct relationship between supply, demand, and the conviction of its holders. Then something changes. The asset becomes large enough, liquid enough, and consequential enough that the established financial system decides it needs to be incorporated rather than ignored. The infrastructure of institutional access gets built. The products, the vehicles, the intermediaries, the derivatives, the entire architecture by which Wall Street converts any asset into something it can trade, package, leverage, and distribute at scale, gets constructed around the asset. And then gradually, then more rapidly, the price dynamics of the asset begin to change. Not because the asset itself has changed, not because its fundamental properties are different, but because the actors who now hold significant positions in it, who stand between retail buyers and the underlying asset, who have the capacity to create and destroy paper representations of it, these actors have different motivations, different time horizons, and different tools than the original participants. I've watched this happen to commodities. I've watched it happen to real estate. I've watched versions of it happen to sovereign debt, to currency markets, to every asset class that was, at some point, considered to be outside the reach of large-scale financial engineering. And I'm watching it happen to Bitcoin right now. Let me be precise about what Bitcoin was designed to be, not as a technical matter, but as a monetary and philosophical matter, because I think the precision matters for understanding what is actually at stake in what I'm describing. Bitcoin was designed to be a monetary asset that is independent of any institution, independent of any government, independent of any intermediary. Its fundamental value proposition, the thing that distinguishes it from every previous form of money in human history, is that it is the first monetary asset whose issuance and transfer require no trusted third party. No central bank, no commercial bank, no clearinghouse, no authorized participant, no one in the middle. This is not a minor technical detail. It is the entire point. For the first time in history, an asset could be held, transferred, and verified without the permission, the cooperation, or the intermediation of any established institution. Its scarcity was enforced not by a government's promise, but by mathematics. Its transferability was not dependent on a bank's willingness to process a transaction, but on a decentralized network's consensus mechanism. The monetary implications of this, if you think them through carefully, are genuinely radical. Every previous form of money, even gold, even cash, has at some point in history been subject to confiscation, manipulation, debasement, or institutional intermediation. Governments have seized gold. Central banks have debased currencies. Financial institutions have created paper representations of assets that exceeded the actual underlying asset by multiples. Bitcoin, as designed, was supposed to be different, not because the people who hold it are different, but because the architecture prevents the institutional interventions that have historically been applied to every other form of money. That was the design. What I'm going to explain is how the gap between that design and the current reality, the gap created by the process of financialization, has grown, why it has grown, and what the implications are for anyone thinking seriously about Bitcoin as a monetary asset. Financialization is a word I use to describe a specific process, the conversion of any asset from its raw, direct form into a set of financial instruments, derivatives, and structured products that allow large institutions to access, trade, and position around it at scale. This process is not inherently malicious. It is, in many ways, a natural consequence of an asset becoming large and liquid enough to attract institutional interest. The infrastructure of institutional access, the custodians, the clearinghouses, the prime brokers, the authorized participants, exists because there is genuine demand for it. Institutional investors have fiduciary obligations, regulatory requirements, and operational constraints that make direct ownership of many assets impractical. Financial products that provide exposure to those assets serve a real function, but the financialization of any asset creates something that the asset's original holders often don't fully appreciate. It creates a layer of intermediaries whose economic interests are not identical to the interests of the ultimate holder. And those intermediaries, precisely because they sit between the buyers and the underlying asset, acquire a degree of influence over the asset's price dynamics that the underlying asset's fundamental properties alone would not give them. Let me be specific about what this means. When you hold an asset directly, when it is in your possession, under your control, not accessible to any third party without your consent, your holding is transparent, unencumbered, and unaffected by what any intermediary does with their own positioning. The price may move, but the movement is driven by the aggregate of buyers and sellers in the direct market. When you hold an asset through a financial product, through a fund, through an exchange-traded product, through any vehicle that interposes an intermediary between you and the underlying asset, your exposure to the asset is real, but your relationship to it is mediated. The intermediary holds the underlying asset on your behalf. The intermediary has its own economic interests, its own hedging strategies, its own positioning around the product it manages. And critically, the intermediary has access to tools, derivatives, options, lending, short positions, that may allow it to manage its own exposure in ways that are not transparent to you and that may not always be aligned with your interests as a long-term holder. This is the architecture that has now been constructed around Bitcoin. An architecture of intermediation that by its structure gives sophisticated institutional actors with privileged positions a degree of influence over Bitcoin's price dynamics that the direct market would not give them. I want to spend some time on the logic of why sophisticated financial actors seek privileged positions in any market, because I think understanding the logic is more important than attributing specific intentions to specific actors. The fundamental business model of a sophisticated trading firm, whether it trades equities, currencies, commodities, or any other asset class, is capturing the spread between prices at different points in the market, across different timeframes, or between different instruments. This is called market making when it is performed within certain regulatory frameworks, and it is considered a legitimate and often socially useful function. Market makers provide liquidity. They narrow bid-ask spreads. They allow markets to function more efficiently by standing ready to buy and sell when other participants want to transact. But market making, particularly when performed by a firm with sophisticated technology, privileged access, and significant capital, also creates informational and positional advantages that can be used in ways that are more ambiguous. A firm that knows the order flow, that sees before other market participants the direction and magnitude of buying and selling pressure, has information that is genuinely valuable. A firm that can create and destroy shares of an exchange-traded product has tools that other market participants don't have. A firm that can hedge its exposure through derivatives that are not fully transparent to the public has a degree of strategic optionality that ordinary holders lack. None of these advantages in isolation constitute manipulation. They are features of the financial system as it exists. But they do mean that the interests of sophisticated intermediaries are not identical to the interests of ordinary holders, and that in any market where sophisticated intermediaries have privileged positions, the price dynamics of the underlying asset are not being driven solely by the fundamental supply and demand of long-term holders. When this happens in traditional financial markets, equity markets, bond markets, currency markets, most sophisticated participants understand it and price it into their expectations. They know the market is not a pure expression of fundamental value. They know there are actors with informational and positional advantages. They invest accordingly. What makes the Bitcoin situation different is that most of the participants who were attracted to Bitcoin were attracted precisely because it was supposed to be a market that was not subject to these dynamics. The architecture of Bitcoin itself was designed to prevent the privileged intermediaries and the informational asymmetries that characterize traditional financial markets. The financialization of Bitcoin has introduced exactly the dynamics that Bitcoin was designed to exclude. I've studied the history of every major commodity that has gone through significant financialization, and the patterns are instructive. In each case, the pre-financialization market had specific characteristics: relatively direct price discovery driven by the fundamental supply and demand of actual users, relatively limited leverage, and relatively transparent positioning. Sophisticated actors participated, but their participation was constrained by the absence of the infrastructure that would allow large-scale financial engineering. The post-financialization market had different characteristics: more liquid, more accessible, more efficiently priced in certain respects, but also more susceptible to price dynamics driven by the positioning of sophisticated intermediaries rather than by fundamental supply and demand alone. Leverage increased. Derivatives markets grew. The relationship between the paper price and the physical reality of the underlying asset became more complex and occasionally more strained. In almost every case, the period immediately following significant financialization was characterized by a pattern that frustrated long-term fundamental holders: periods of sideways price action, occasional sharp downward moves that seemed disconnected from fundamental changes, and the sense that the price was being driven by forces that had nothing to do with the underlying asset's properties. And in almost every case, that period eventually resolved, sometimes after years, in one of two ways. Either the financialization overwhelmed the fundamental market permanently, and the asset's price dynamics became essentially indistinguishable from other financial assets, losing the distinctive characteristics that had originally attracted long-term fundamental holders, or the fundamental properties of the asset eventually reasserted themselves against the financial engineering, usually during periods of macro stress when the financial engineering became too expensive or too transparent to sustain. For Bitcoin, which direction this resolves is one of the genuinely important open questions of our current moment. And I want to be honest about the uncertainty here, rather than pretending to a confidence that the evidence doesn't support. I think the most useful framework for understanding what has happened is to recognize that there are now, in a meaningful sense, two Bitcoins. There is the original Bitcoin, the cryptographically secured, decentralized bearer asset that exists on the blockchain. The Bitcoin that you hold when you control your own private keys. The Bitcoin that requires no intermediary's permission to transfer, that cannot be confiscated by a financial institution, that is not subject to the lending, leveraging, and hedging activities of any authorized participant. This Bitcoin has all the properties that its original design intended. And then there is the financialized Bitcoin, the exposure to Bitcoin's price that you hold when you own shares of an exchange-traded product, or when your Bitcoin is held in custody by a financial institution, or when you are accessing Bitcoin's price through any derivative or structured product. This Bitcoin's price is influenced, to a degree that is difficult to measure precisely but that is structurally significant, by the positioning, hedging, and strategic behavior of the sophisticated intermediaries who sit between you and the underlying asset. The financialized Bitcoin is not fake. The exposure is real. If the price of the underlying asset goes up, the financial product's value goes up. If it goes down, the value goes down. But the financialized Bitcoin is subject to dynamics that the original Bitcoin is not. It is subject to the lending of the underlying asset by custodians. It is subject to the short selling and hedging activities of authorized participants. It is subject to the liquidation cascades that happen when leveraged positions are unwound. It is subject to the price action of the futures and options markets that have been built around it. It is, in short, subject to the full apparatus of financial engineering that has been constructed around it. This distinction between the two Bitcoins is not academic. It has practical implications for how you hold Bitcoin, what risks you are actually exposed to, and what role Bitcoin can realistically play in a portfolio during different kinds of market environments. The holder of original Bitcoin, self-custodied, keys controlled, no intermediary, is exposed to Bitcoin's fundamental price dynamics but is insulated from the dynamics of the financial engineering layer. Their position cannot be liquidated by a margin call from a prime broker. Their holdings cannot be lent out without their consent. Their Bitcoin is not accessible to the hedging strategies of an authorized participant. The holder of financialized Bitcoin, through an ETF, through a custodian, through any intermediary, has the price exposure but also the full suite of risks that come from being inside the financial system that Bitcoin was designed to exist outside of. Let me be very clear about what I am and am not saying here, because I think the nuance matters and I don't want to be misread in either direction. I am not saying Bitcoin is not a valuable asset. I believe Bitcoin has genuine properties, mathematical scarcity, decentralization, bearer asset characteristics that make it a legitimate and important part of a diversified approach to wealth preservation, particularly in a period of monetary system stress like the one I believe we are in. I am not saying that holding Bitcoin through financial products is necessarily wrong. For many investors, given their specific circumstances, their risk tolerance, their operational constraints, accessing Bitcoin through established financial infrastructure is the most practical approach. The liquidity, the regulatory clarity, and the integration with existing portfolio management tools have real value. What I'm saying is that the financialization of Bitcoin has created a genuine gap between what Bitcoin was designed to be and what Bitcoin, the financial product, actually is in practice. And that understanding that gap, its nature, its implications, and its relevance to your specific situation, is essential to thinking clearly about Bitcoin as a monetary asset in the current environment. The gap matters most during periods of acute financial stress, when the financial engineering layer is under pressure, when leveraged positions are being unwound, when intermediaries are managing their own risk, when the dynamics of the paper market are most divorced from the fundamental dynamics of the underlying asset. The two that the two Bitcoins behave very differently. The self-custodied holder sees the price move, but nothing else changes about their position. The financialized holder is exposed to all the dynamics of the financial layer in addition to the price movement. This is not a minor distinction. In periods of acute stress, it can be the difference between maintaining your position and being forced to exit it, between holding through the volatility that historically precedes significant upward price movements and being liquidated at the bottom. The principle is not complicated. If you hold Bitcoin because you believe it is a monetary asset that should exist outside the financial system, the most coherent expression of that belief is to hold it in a way that is actually outside the financial system. That doesn't mean everyone should immediately restructure their holdings. It means understanding what you actually own, what risks you are actually exposed to, and whether the gap between what you think you own and what you actually own has implications that are relevant to your investment thesis. Before my closing thoughts, 3 brief things. First, I've put together a framework document that covers how I think about Bitcoin's role in a portfolio that takes the monetary transition I've been describing seriously, including the distinction between direct and financialized exposure, the specific risks each carries, and the conditions under which each is more or less appropriate. It's in the description and completely free. Second, if you want to go deeper on these dynamics, on the intersection of macro monetary analysis and the specific behavior of Bitcoin as both a monetary asset and a financialized product, I've built a community of serious thinkers around exactly that kind of rigorous analysis. Details are in the description. Third, if this kind of honest, framework-driven thinking is useful to you, subscribe. These dynamics are going to keep developing, and I intend to keep tracking them clearly. Let me close with this. The title of this video is How Wall Street Took Over Bitcoin. I chose that framing deliberately because I think it captures something real, not as an accusation of malice, but as an observation about structure. Wall Street didn't take over Bitcoin through any conspiracy. It took over Bitcoin the same way it takes over every asset that becomes large enough to attract its interest, by building the infrastructure of intermediation around it, by constructing the products and vehicles and privileged positions that allow sophisticated institutional actors to sit between buyers and the underlying asset, and by importing the full apparatus of financial engineering into a market that was designed to exclude it. This process has real consequences for how Bitcoin's price is discovered in the short and medium term. It has real consequences for the relationship between the paper price and the fundamental properties of the underlying asset. And it has real consequences for any investor who holds Bitcoin primarily because they believe in what it represents as a monetary asset, and who needs to understand whether the form in which they hold it is consistent with that belief. Bitcoin as designed remains one of the most remarkable monetary innovations in human history. Its fundamental properties, the mathematical scarcity, the decentralization, the bearer asset characteristics, are intact. The financialization doesn't change what Bitcoin is. It changes how the market currently prices it, who influences that pricing, and what risks are embedded in different ways of accessing the exposure. Understanding that distinction clearly without either dismissing the financialization concern or overreacting to it is, I think, essential to navigating Bitcoin intelligently in the current environment. That's the honest picture. As always, what you do with it is your decision. I'll see you in the next one.